Hey, in today's video, we're talking about can poor tax planning cause your Medicare premiums to cost more? The fancy term for this is your IRMAA, your income-related monthly adjustment amount, which basically means the amount that you have to pay for Medicare Part B, and it's based on your income. Can you plan poorly and end up having income that's too high and you get slammed on your Medicare premiums? Well, the answer, of course, is yes, it can happen. So let's figure out how and how not to let it happen to you. Coming up next. Hey, this is Mel Stubbs. I'm a financial planner at Christy Capital Management, where we're helping federal employees plan for a better retirement. If you need individualized help, go to christycapital.com, click Talk to an Advisor. In today's video, we're talking about Medicare premiums. How are they determined? And can you back yourself into a corner where you're going to get hammered on your Medicare premiums if you don't plan well? So Medicare premiums for 2025 are going to be starting off at $185 a month. And if you're married, it's going to be another $185 for you and your spouse. Let's say that you're married. You can see as long as your income, and that's your modified adjusted gross income, is less than $212,000, your premium would only be $185 a month. So what's so fancy about modified adjusted gross income? Well, that is income where you don't get to count your standard deduction. It's technically your adjusted gross income with some adjustments added back to it. So for our purposes, just know that your modified adjusted income is higher than your taxable income. So sometimes when we're doing planning, we're basing the amounts on the tax brackets and your taxable income. But note that Medicare uses modified adjusted gross income, so if it's below $212,000, your premium is $185 a month. If it's between $212,000 a year and $266,000 a year, there's a $74 increase, and it's going to be a $259 cost a month. If it's greater than $266,000, up to $334,000, that's your income, it's $185 higher, which means it's going to be $370 a month for you and your spouse. Now, keep in mind that the 24% tax bracket starts at $206,700. So as long as you stay below the 24% bracket, there's no adjustment. But when you get into the 24% bracket, you can see the 24% bracket goes all the way up to $394,000, which means there are 3 Medicare adjustment premiums just in the 24% bracket. So now let's look at a scenario where someone's income starts getting into that 24% bracket, because as soon as it does, Medicare premiums are going to cost more. So here's an example of someone's plan where you can see, right here, they're in the 12% bracket up to age 72. But then we have the smaller RMDs kicking in, which bumps them up to the 22% bracket. But then in 2045, when the larger IRA starts its RMDs, you can see there's going to be a $213,000 required minimum distribution, which skyrockets them up into the 24% tax bracket. Not only does this mean they're going to be paying a higher tax rate on their distributions that are being forced to be taken out, but it also means that their Medicare premiums are going to be higher. Here's a different way to look at it. You can see from 2027 to 2044, they are below the purple line, which means they are below the 24% bracket. They will be paying the regular Medicare premiums. But as soon as that RMD kicks in, you can see how that at that point, the income is going to be above the 24% line. You can see in some years it's going to be above the 32% line. Some years it's above the 35% line. So all of these future years, their Medicare premiums are going to get hammered. Now the highest Medicare premium is $629 a month, and that would be for you and your spouse. This chart is showing that some of the years that's going to be happening, so that could this person have done anything to fix this? Well, for the sake of this video, let's assume this is you. What can you do to fix the situation? Well, if you look at this illustration on the left side, you can see how there's lots of room in the lower tax bracket. The person is going to be in the 12% bracket for a good number of years. There's room in the 12% bracket that you could Roth convert. There's room in the 22% bracket that you could convert. So let's look at what this looks like. In this example, this person is converting up into the 24% bracket. So you see the yellow bar chart? That shows the amount of Roth conversions each year. Now, a little piece of it would be in the 12%, a little piece of it you'd be paying 22%, and then a chunk of it you'd be paying 24%. And you can see how the income is a lot lower out in the future. We've gotten rid of the required minimum distributions. Their income is a lot lower, and having lower income would mean that you'd be paying the minimal amount for Medicare. Now, there's still some years out there in 2049 and 2052 where the income is really high, but that's coming from taxable investment earnings. This person has a lot of leftover money that's building up in a taxable account, and if you don't plan well, you can have a lot of 1099 interest from maybe CDs or capital gains, which can push your income higher. This is showing you a bad case of paying taxes every year and having some of the income getting really high. This could be planned around if you're working with a professional. So not only does it say here that the person will save $1.7 million in lifetime taxes by going ahead and paying the tax early instead of letting it just accumulate, you're going to be saving money on Medicare as well. So what's the takeaway? If you have $1 million in your TSP and you're in your early 60s, there is potential that that's going to grow to the point where your required minimum distributions, not only are they going to kick you into higher tax brackets, which will cost you more tax dollars over your lifetime, but it will also cause, or it could cause, your Medicare premiums to go up. And that goes up for you and your spouse if you're married. Can both of these things be fixed? Yes, with proper planning, early enough, doing the right things, this can be fixed. So reach out to us at ChristyCapital.com because we would love to help talk with you about this. We've got a new book going over the 10 decisions that you have to make at your federal retirement, so check that out as well. You can go to ChristyCapital.com/decisions for the book. If you want to talk to us, go to ChristyCapital.com and click Talk to an Advisor. If you want to see a video on whether you should have your Roth account invested differently than your traditional, check right here. My name is Mel Stubbs. Let's make sure you're planning to the best of your ability, and if you need help, we'd love to help. I'll see you on the next video.